We have learned the concepts under Ind AS 36, impairment of assets. We would now like to apply that learning of those concepts with the help of several questions to test our knowledge on the same. We are given this information which says that on 1st of April 2021, P acquired 80% stake in S Limited by paying 21 crores. The fair value of net assets in S Limited on that date was 15 crores. P measures the NCI at the proportion of net assets method. Assets of S Limited constitute a CGU. Further, other CGUs of P are expected to benefit from the business combination, and the goodwill of 5 crore rupees is allocated to those CGUs. On 31st of March 2022, P determines the recoverable amount of the investment in S Limited as 10 crore rupees. The carrying value of S Limited on the date is 13.5 crores, excluding the goodwill. The requirement of the question is measure the impairment loss as on 31st of March 2022. Right? So there's a lot of information given to us. The way we want to structure is basically we need to calculate first of all the amount of goodwill, because we understand that once we have determined the impairment loss, okay, we would need to allocate that first to the goodwill. And if there is any balance remaining, okay, that would be, of course, charged to other assets on the basis of or in the proportion of the carrying value of those assets. That's where the first step of calculation of goodwill comes in picture. Now, the other point that you also want to remember here is that we are provided with the information that the NCI, the non-controlling interest, is measured as or at a proportion of net assets method. Okay, and that is where we start looking at that the goodwill needs to be grossed up, because the moment we say it's a proportion of net assets method, this goodwill is purely reflecting parents' share, which is basically 80% indication given to us, right? We need to gross it up to 100% to measure the impairment loss calculation, right? So that's the way we want to flow. That's the way we want to move ahead with this particular question's requirement. Let's do this together. I'm provide the information that's an 80% stake. You paid 21 crores and the fair value of the net assets is 15 crores, right? That is sufficient information for us to calculate the value of goodwill. We would say the purchase consideration is given at 21 crores. I will reduce fair value of net assets, which is 15 crores, but 20% of this, my non-controlling interest, that is NCI, which becomes, of course, 3 crores here. So effectively, we are saying that you're paying 21 crores to acquire something worth 12 crores, and that gives you a goodwill on acquisition of S Limited, right? Now, it doesn't stop here. Out of this 9 crores, we are also provided that 5 crores is allocated to other CGUs, which means that I will break this 9 crores and say that other CGUs have a goodwill worth 5 crores, and as attributable to S Limited, the balance amount of 4 crore comes in picture. All right, so that's where the first step is coming in. We have calculated the value of goodwill, and out of that goodwill, we have also measured the goodwill which is applicable or allocable to S Limited, that subsidiary in which we have got 80% stake. All right, now the second step that we have got is basically about measuring what is your carrying amount and recoverable amount on the date of reporting, which is 31st of March 2022. So let's mark it here. Okay. So this was 1st of April 21. This is 31st of March 22. Okay. The carrying value is provided to us as 13.5 excluding goodwill. So we'll take that. Plus, of course, the goodwill has to be added. Now, this goodwill of 4 crores has to be grossed up to reflect the group's goodwill, right? That's how you start looking at the total measurement. So this becomes 5 crores and the total amount of investment in S Limited from a notional perspective is 18.5 crores. And we are provided, by the way, that the recoverable amount is given at 10 crore rupees, which means that my impairment loss will be measured at 8.5 crore rupees. Okay. Now, importantly, what you also want to remember here is that the moment I see an impairment loss, we charge that impairment loss first to goodwill. Okay. So we say that under Ind AS 36, impairment loss is first charged to goodwill and the balance is charged to other assets. Again, as we said before, on the basis of a pro rata value, on the basis of a proportion of the value of the assets appearing in the balance sheet. Now, importantly, in this case, what we want to remember here is that the total goodwill is 5 crores, which is the notional value. Okay. But the true goodwill on acquisition is indeed 4 crore rupees as far as S Limited is concerned. That's what we are trying to focus on, which means that out of the total impairment loss, of 8.5 crores, we shall recognize 7.5 crores of loss, because this 1 crore is the differential, the 5 crores and 4 crores. The difference between the two values is purely a notional amount of goodwill. So in a way, we have set off that 1 crores impairment loss from that notional value of goodwill. Okay, which means that now the remaining 7.5 crore rupees of loss will be first offset or adjusted from the goodwill, which makes the goodwill as 4 crores minus 4 crores, that is 0. And the balance amount, the other assets, and of course that would be 3.5 crores. Is it fine? Right. Let's have a look at the formal solution. We are provided with this information, of course, that the purchase consideration is 21 crores, net assets are 15, but you already had, 3 crore rupees, which is basically your non-controlling interest. So effectively, you're only paying, you're actually, receiving 12 crore rupees as a group for which you're paying 21. That makes the goodwill calculation at 9 crores. Out of those 9, 5 is going to the other CGUs and the remaining 4 is allocated to S Limited. And then we are talking about the concept. Since the NCI is measured at a proportion of net assets, the goodwill is included in the recoverable amount, but has not been recognized in P's group financial statement. And that is where it is to be grossed up to arrive at the parents or the group's goodwill for that matter. And that's where it becomes 4 plus 1, making it 5 crores, right? These are the steps that we would take to calculate the goodwill, and of course, looking at the full goodwill calculation there. Okay. Now we're talking about, of course, the information around it, that my total other assets carrying value is 13.5 crores. Adjusted amount of goodwill, the notional value, the full value of the goodwill is 5 crores, making it total 18.5, out of which I will reduce recoverable amount of 10, which is resulting in an impairment loss of 8.5 crores. Okay, and finally, we start looking at that impairment loss is first charged to the goodwill. Since the goodwill is only recognized to the extent of parent share, we should be also recognizing a loss to the extent of 7.5 crores and not 8.5 crores. And the entire goodwill would be wiped off with this 4 crore rupees amount. And the balance of amount of 3.5 crores would be charged to other assets on the basis of the proportion of the value of those in the books. We're now looking at this question where we provided the details. The question says X Limited purchased an asset for 10 crore rupees on 1st of April 2017. The life of the asset is 4 years with no salvage value. The recoverable amount of the asset during next 3 years is given as under, which is year ended 31st of March 18, the recoverable amount is 6 crores. 31st March 19, the recoverable amount is 4 crores. And 31st of March 20, recoverable amount is 2.8 crores. The requirement of the question is to measure any impairment loss and reversals during each of the years, right? Think about what is an impairment loss. How do you calculate an impairment loss? We say that where the carrying value exceeds recoverable amount, that is where it causes an impairment loss, right? And we also say if later, because we're talking about the reversals also, if the carrying value is less than, if the carrying value is less than recoverable amount, then we can reverse any existing impairment loss. Now, this is a restricted one because we can only reverse to the extent of the impairment loss available, right? We can't reverse more than that. Okay, that's what we want to remember here as a context. So with this information, let's use these numbers. The cost is given, initial estimate of useful life is given, salvage value is 0, that is also provided, and we are also provided, of course, with the recoverable amount at the end of each year. So what are we supposed to do? We are supposed to measure the carrying value at the end of each year, and that's where we compare that with the recoverable amounts at each respective date. All right, let's do this together. I'm provided with the information that cost of the asset is 10 crores. Useful life is provided at 4 years, which means that my annual depreciation will be 2.5 crores. That is for the year 1, which means that at the end of year 1, 31st of March 18, my carrying value will be 10 minus 2.5, that becomes 7.5 crores. against which I'm provided the recoverable amount, which is 6 crores. Now, this obviously my carrying value is more than the recoverable amount, which means that I need to recognize an impairment loss to the extent of 1.5 crores. Now, how do we recognize the impairment loss? We naturally bring the asset's value, down by 1.5 crores, which means that on this date, my revised carrying value is 6 crores to me. Is it fine? Right? We use now this 6 crores for the calculation of the future depreciation. Okay. Now, what I'm going to do is basically look at year 2, where I'm provided the carrying value, which is 6 crores, useful life, which is 3 years, and finally, that results into an annual depreciation of 2 crores. With that information, I can simply calculate the carrying value for or as on 31st of March 19. The carrying value will be 6 minus 2, that is 4 crores, and I'm also provided with the recoverable amount, which is 4 crores, which means that, let's have a look at it again. This is the value, right? So this 4 crores basically results in the carrying value being equal to the recoverable amount, which means that I'm not going to do anything in my books for the year 2. That is on 31st of March 19. There's no further impairment loss, not even a reversal. All right. But now I go further on year 3, wherein I use the existing carrying value, which is 4 crores. My estimate of remaining life is now 2 years, which means my annual depreciation is now 2 crores, which is 4 by 2, right? That means that the carrying value on 31st of March 20 is the balance 2 crores. Against this, I'm provided with the recoverable amount of 2.8 crores, right? Now, the carrying value is less than the recoverable amount. Can I reverse the impairment loss? Well, I can do that, provided my impairment loss is at least 80 lakh rupees. So the difference between the two is, of course, 80 lakh rupees. But in the year 1, we had to charge an impairment loss of 1.5 crores. What are we trying to say now? In the year 3, yes, a reversal of impairment loss to the extent of 80 lakhs will be done, and the revised value of the asset or revised carrying value of the asset will be 2.8 crores. All right. Let's have a look at the solution. It's again, of course, the same information that we have done. Since the carrying value is higher than the recoverable amount, impairment loss will be recognized. And that's what we have done. We have recognized the impairment loss of 1.5 crores in the year 1. Second year, all the values are same. Both the carrying value and the recoverable are the same. Therefore, no impairment loss needs to be recognized. In the year 3, however, we have the carrying value less than the recoverable amount. And since we already had recognized a loss of 1.5 crores to the extent of 80 lakh rupees, we can reverse that loss. All right. Thank you very much.